Hey folks, it's Dave Burrows. I'm CIO here at Barometer Capital Management, and thanks everybody for joining in. It's pushing up to the end of August, and things are a little quieter, although we had a big week last week with the Jackson Hole speech from Fed Chair Powell. We got NVIDIA earnings coming tomorrow, which I think people will watch with bated breath. Pretty crowded trade and lots of people there. A little weaker recently. And it's just an interesting time to be assessing things as we head into the fall. Seasonally, you can get some bounciness in September, so we're watching for signs of that. And we're always reevaluating the positions in our portfolios to make sure that they continue to line up with what's going on in the market, and looking for any kind of new signs of leadership, any shifts in market power, to make sure that we stay aligned. Just from the top, to kick off, we continue to be in the structural bull market that started now over a decade ago. They tend to go on for 15 or 18 years. We made a new high after the cyclical bear market that was resolved in January of this year. We're now about 8 months into an advancing market, relatively low volatility, as it tends to be in between cyclical bear markets. And probably we are only, kind of a third of the way along, maybe less, in what will likely be a pretty productive time. Now, we know there's corrections along the way. You get 2 or 3 5%ers a year. You tend to get 10% a year. When we look at the S&P recently, well, we saw a 9.6% pullback during the month of August. And quickly, the market did reverse up and rally back. It has yet to make a new high, but it's been pretty darn close. Not everything has participated the same way. We're going to talk a little bit about that today. But in general, things have been getting better. Now, early in the summer, we highlighted that a small percent of stocks were leading the market. Really only about 25% of stocks in the month of June were ahead of the S&P on the year. It's a different picture today. It's been getting better. When we look at the earnings estimates, these are street estimates, consensus, looking out to next year. Consensus estimates have been rising. It looks like we will likely come through 2024 with between 10 and 11% earnings growth. Revisions actually have not been bad from a seasonal perspective. You tend to get a lot of downward revisions in July, August, and September. But the revisions for next year have been higher. And part of the thing that we're focused on is that a lot of the contribution expected next year for earnings in the S&P come from the rest of the market as opposed to the Magnificent Seven. I do think it's really relevant that the equally weighted S&P, after lagging over the last 4 weeks, has been working its way higher, and this week we made a new all-time high. So that's interesting. I mentioned last week that in the previous 30 days, 63% of all the constituents in the S&P were ahead of the index. That's a change. It fits with the narrative that came out of the big push that we saw, the breadth thrust in small and mid-cap stocks. That hasn't gone away. Last Friday in the S&P, advancing volume versus declining volume was 14-1. In the Russell 2000, it was 27-1. Which really is quite an extraordinary number. When we look at the cumulative advanced decline line, the NYSE taking all issues, the cumulative advanced decline line for stocks made a new all-time high. And so breadth has been improving. Very different than what happened when we came into the 2021-22 sell-off. You had the market making a new high, but fewer stocks in the advanced decline. So this is what we look for. A healthy market should have a higher and higher percentage of stocks participating. When we look at the number of stocks making a 20-day high, that's been ramping nicely over the last couple of weeks. Certainly not overbought, certainly not weak. It's moving up nicely, and moved up a little bit more over the course of this week. So market is reasonably constructive. especially given, seasonality. I think things look pretty good. Now, we've been following the US dollar versus the basket of world currencies. We highlighted that over the last few years, as we get big run-ups in US dollar, tends to be during a weak stock market. It's a flight to safety. And when Brent made lows in June, it was a little bit of a bump in the US dollar, but we have been looking for a US dollar that was going through a topping process. And we're of the view that if the US dollar were to start to weaken, it would be on the back of expectations for interest rates and the Fed getting close to cutting. Now, last week at Jackson Hole, you really couldn't read Powell's comments in any way other than being dovish. He said specifically that time has come for policy to adjust. He talked about with an appropriate dialing back of policy restraint, there's a good reason that the economy could get back to 2% inflation while maintaining a strong labor market. Now, what he said is one thing. What the market did is what's more important. And we've seen the US dollar sell off sharply and really against all currencies. Now, we got a little wobble in the Japanese market, a little wobble, 12%, 3 weeks ago when the Japanese yen broke this downtrend that had been in over the previous 3 years. Yen has stayed firm, but the Japanese stocks have bounced back. And it's not just Japanese yen that's been strong versus dollar. The pound has been stronger. The euro has been stronger. And here where I sit, the Canadian dollar's been stronger. Now, it's interesting to me that the Canadian dollar has held these lows at 72 cents over the last 18 months, while consensus on the Canadian dollar has become exceedingly bearish. I think it sets up an opportunity for the Canadian dollar to firm against consensus, especially when you look at the Canadian dollar positioning. When you look at net positioning in the Canadian dollar, short positioning, it's the most bearish in history. I think that sets up an interesting dynamic. Now, part of the thing that investors are looking at is the political situation. But on the other side, we spent a lot of time over the last couple of years talking about the setup in commodities. And we can't forget the Canadian dollar tends to be heavily influenced by what's happened with oil and what's happening with basic materials. And certainly we've seen some firming there. This could be an interesting contrarian trade. We in our portfolios, the pools and the funds that we run have got everything currently hedged back to Canadian dollars, wanting to take out the impact if the Canadian dollar starts to firm versus our US investments, wanted to make sure that that was netted out. So we don't have risk if the Canadian dollar bounces. When we look outside of North America, with a weaker dollar, it tends to be there's money getting put to work other places. The Nikkei has been leading, coming out of a very long bear market. Look at this recovery from the sell-off, basically right back towards highs. India has continued to be very solid. There's a bad label. Argentina, it's been parts of Latin America acting very well. And the Canadian market made new all-time highs in the past week. So there's a lot of global markets coming out of long periods of underperformance. We think that that's important. We think that they're under-owned assets. In general, valuations for global stocks are much lower than US. And that's why we put an allocation of 5 to 10% across all portfolios in an index that we created of 80 companies, made up 50% of strong relative strength technical companies and 50% high quality value situations where we're starting to see an improvement in relative strength. And that global portfolio seems to be doing pretty well. So we think this is probably an important theme to consider. Many people have exited global positions over the last number of years, and you can't blame them. In general, global stocks have underperformed. The one area that is not performing well is China. China has continued both on an absolute basis and this blue line on a relative basis versus the S&P to crater. It may be that it's getting sold out. It's not for me to say. We don't buy weakness, but we have no exposure here. On fixed income, certainly the series of higher highs and higher lows and yields has not been broken. We haven't made a new high recently, and in the little rally that we've had in bonds, we've not seen a lower low in yields. So when we look at the chart of the long-term US Treasury bond. It continues to be in a series of lower highs and lower lows. We'll see whether that changes, but for now, we continue to be in a bear market. And certainly there's really not been much bounce in fixed income. Lots of folks have looked for an opportunity to buy fixed income. And certainly, bonds have bounced a little bit, but they are in a very different type of drawdown than we've seen over the last number of years. The Chinese are active sellers, as are many other foreign buyers. And so when we do a comparison, stocks versus bonds, stocks clearly are winning. And so given a choice in the portfolios that we run, where we have discretion, we have focused on stocks. We have not focused on fixed income. And for income investors, we've focused on dividend growth as opposed to bonds, which clearly are outperforming. If we take the data from October 13th of last year, which was the day that yields peaked, the aggregate bond index has bounced since then, 10.7%. The equal weight S&P is up 25 over the period. Dividend growth ETF RDVY up 29%. So it may be that bonds do well when yields come down. There are other things we think can do better. REITs certainly have picked up relative to bonds. Interest sensitive. We've been focused on residential REITs. This is the REZ, which we own in our macro portfolio. Very nice pickup in relative price performance. This was an ad in the spring of this year. And utilities relative to bonds certainly outperforming. We focused on Southern Company and NextGen. And then pipelines are performing well. This is the Pembina pipelines versus the XBB, which is the Canadian Broad Bond Index. In many cases, dividend yields are higher than what we can get in fixed income. Certainly the tax treatment is a lot better. And we think total return ultimately, can outperform. So lots of opportunities to be creative in building yield-based portfolios. And really the key common characteristic in everything that we're trying to own are things that can pay us more over time and help generate a stream of cash flow that can more than offset the impact of a rising cost of living. We get to commodities. This is one of the hedges that we've used against inflation. Had its first leg higher from 2020. We've gone through the tightening cycle and commodities have come out of that. In fact, we did pull back earlier in the month, on some of the concerns around a weaker economy. Look at the way commodities have come right back. They're now up on the month. WTI is still sort of in its consolidation. We'll see which way it goes. The stocks have been acting a little better. Gold certainly has been acting well. It's up the last 5 months in a row, up 19%. In fact, this is about the best performing asset in the market. And acting a lot like it did coming out of the last bear market. I would say we're probably very early stages here. Now, I mention this each time because I think this is an asset that's under-owned and we are not gold bugs. But we know that when you go through a bear market, companies stop spending money trying to find new production. And when we look at the number of new discoveries over the last number of years, you can understand why this is a constrained asset. I do think it's really important that in the last 45 years, there has not been a time when gold was less volatile than a treasury bond. So think about it. It's one of the best performing assets here to date. It has had exceedingly low volatility, but compared to other gold cycles, gold is an exceedingly small part of most portfolios versus where it got to at the end of bull markets. This can grow a long way. I have to think that as an asset, this is going to become a bigger part of portfolios as we go along. Outside of that, copper came right down to the long-term trend line as we talked about 4 weeks ago. We've had 3 weeks in a row where copper's bouncing, but that's probably the last stop. My guess is before it really starts to firm. And when it starts to firm, it can go a long way. So this is on a monthly basis. This is the bear market from 2010 through 2021. This is the global tightening cycle. We're clearly coming out of that. We think that looks quite interesting. And same picture when prices are low for an extended period of time, not a lot of new copper found. And we think that there is a small number of companies with new production that have an opportunity to generate a lot of cash. So in general, stocks and commodities interesting, fixed income less interesting. Since the beginning of the year, the equal weight S&P is up 11%, the TSX up 13%, outperforming the equal weight. Aggregate bond index up 3.6. Our mixed income strategy up 18.7. Equity strategy up 17. Our global equity strategy up just about 10. And since the market started to broaden in the middle of March of last year, so now coming up on about 16 months, the income portfolio is up about 32%. Our equity strategy is up 37%. And our global fund is up about 25%. So certainly things are working in the right direction. Now, we don't have to be everywhere. We try to target leadership. Leadership, I would consider as an asset that's going through a positive revaluation where maybe the fundamentals are improving, but the multiple that investors are prepared to pay is expanding. As you go through a bull market, generally you get a combination of both. We're always looking for change. And over the last few months, we did see a pickup in some more rate sensitive assets like utilities and REITs. And in the absence of leadership, we certainly have a willingness to go to cash. We're trying to be tactical about this. But I don't see a case for it currently. Over the last couple of weeks, breadth has really started to expand again. If we look at the percent of stocks in uptrends in Canada, in the US, and globally, it is expanding in all three. The first group that turned up, the Canadian market, started to see some breadth expansion about a month ago. 2 weeks ago, world bullish percent, or the percent of stocks in uptrends, turned higher. And over the last 10 days, NYSE bullish percents turned higher. Before that happened, the percent of stocks trading above their 50-day moving averages, both in Canada, in the US, and globally, did turn higher first. We look in the US, just over 50% of stocks have positive weekly price momentum, in other words, upward price trajectory. The percent of stocks making new highs versus new lows now over 90%, and the percent of stocks trading above their 150-week or long-term moving average now sitting just about 65%. These are all positive numbers. What does this mean? It means that the market is in a position where, when we're seeing expanding breadth, to absorb bad news. A lot of people have questions about the election in the US. A lot of people have questions about various pieces of economic data, but internally, the market is getting stronger. Its ability to absorb bad news is getting better. When we look globally, we can see the vast majority of geographic regions in green, meaning bullish percent, or the percent of stocks in uptrends, is expanding. That's healthy. But the average country has 39% of stocks within uptrends. This doesn't get overbought until it gets to 70 and 80%. So the obvious outlier is China, and you can see breadth not only is contracting, but very narrow, a small percent of stocks in uptrends. When we move to the right, we've got Europe, we've got some Latin American countries, we've got the US, we've got Australia, we've got Asia Pacific, all positive. So this is really, really positive. One country seeing expanding breadth is good. To see a lot of them with expanding breadth tells us there is appetite for equities around the world. So coming into the fall, how are things set up? We have followed financials very closely over the course of the year. That's been our biggest weight, just about 25% of all of the firm assets. XLF, which is the broad-based financials ETF, made a new all-time high today, and it has been moving higher very nicely month by month over the last 10 months. Certainly, we're seeing the percent of stocks making 20-day highs moving sharply higher, not overbought, but certainly acting better. When we look at industrials this week made a new high, just off the highs today. Materials continuing to improve, acting quite well. And energy over the last 2 weeks has started to come out of this consolidation range that it's been in over the last number of weeks. Specifically, large cap, long life oil producers here in Canada, like Imperial Oil, Suncor, and Canadian Natural Resources. They're certainly acting better than some of the frackers in the US, and certainly acting better than some of the gas producers. As far as longevity goes, this bull market in energy has been fairly short-lived relative to other secular bull markets. So we think that there's room to go. From a sector perspective, we talked about utilities over the last little bit. They've continued to march higher here through June, July, and August. Residential REITs are performing really nicely. We've got a nice weight there in our macro portfolio. This is the REZ ETF. Look, relative strength really started to move higher in April. So outperforming the S&P and the utilities ETFs, showing us the same picture. The one area that's going to be a big question mark is semiconductors. This is a group that we did have a big weight in, and we certainly have taken it down. We have one position left, that's Broadcom. We came out of our NVIDIA. We came out of our Qualcomm. I do think it's interesting that when the group sold off, it sold off 24.5% over 14 days. We've rallied back roughly half. When I think about leadership should go down less than the market and should go back to new highs immediately. This is not the case. So on a relative basis, this group is struggling a little. And we had a little bounce in the percent of stocks making a 20-day high, and it's come right back off again. So I think the setup into NVIDIA's earnings is a little bit problematic. We have not added any exposure in this group. I do think that money has been rotating to sectors where earnings are picking up, having been weak for a couple of years, and areas that are a little bit less crowded. We have one new position that we've added over the last 3 weeks, and that is Ferrari. This is a company we've wanted to own for a long time. I think a lot of people have wanted to own a Ferrari. But Ferrari really is a unique company. They have 74% of the cars that they build are sold to existing customers. You can't walk in and buy a Ferrari. They want to know how many used ones you bought along the way beforehand. Their margins have been going up really, really nicely. Pre-tax margins have gone from 18% to pushing towards 50%. Their return on equity has been very, very strong. They have a very strong cash generation. They generated positive cash even during COVID. And they sell only about 8% of their cars into the Chinese market. So the luxury car market is a unique one. They've done a great job of managing their market. And we think that they can grow their pricing by about 5% a year, which means they probably grow their EBITDA between 10 and 15%. And you can see when the market wobbled, the stock did not wobble. It consolidated for a few months and broke out on the most recent earnings. And it doesn't look like it wants to look back. So this is one of the only consumer names that we own outside of Dollarama, Loblaws here in Canada, and Costco. But we do think that it is a luxury car company without any Chinese exposure. That makes it pretty darn attractive. So what does it look like? The portfolios haven't changed a whole lot. Financials continue to be our biggest overweight. Industrials are about a 50% overweight. Our energy weight has been growing, and that's been a combination of pipelines and energy and oil producers. Technology continues to be about a third of the weight of the S&P, which I think is a little bit unique against a lot of managers. We continue to have a pretty strong weight in the materials area that's made up of a combination of copper and gold producers. Our healthcare weight is very targeted. We've continued to target Lilly and Novartis, and consumer discretionary has been relatively low. Some of the defensive sectors a little bit lower weight. But you can see that we've taken the cash down close to zero, and that is the case when all of our breadth models are positive. We want to be invested, and generally, that happens at a time when people have some worries, but we think that the risk reward looks pretty good as we head toward the end of the year. We can't forget that we are now in an improving liquidity environment. No central banks raised rates in the month of June. You did have Japan raise rates in July, none in the month of August. We're going to get rate cuts in September. So we think things generally look pretty good. From a risk perspective, credit spreads continue to be pretty benign. Volatility came right back into the range, having spiked higher on the Japanese sell-off. This is unusual to see it reverse right back into the range that we tend to be in during cyclical bull markets. Very different than other spikes over the last few years, which tells us the Japan issue was, pretty much a technical issue. So not a lot new. We're watching for change. The portfolio certainly has broadened out a bit, adding utilities and REITs over the last sort of month and a half. We're looking for new positions. We're trying to be hypercritical of the existing positions we're in. But in general, we think that the market continues to look constructive. We can't forget that a low volatility period through a cyclical bull market is not unusual. So for the people waiting for a big pullback, they may wind up being disappointed. If things get more difficult and our breadth models point to more defensive environment, we'll be happy to get defensive. But as it stands right now, I think that the key themes continue to look pretty good. So with that, I'll take a look and see what questions we have. Volumes very low in market in general, just due to seasonality. Yeah, look, August tends to have lower volumes. People are away. This is the quietest 2 weeks of the year. We shouldn't expect fireworks. The fact that breadth in general is getting better, I think, is positive. We talked over the last couple of weeks, there are some flows coming from hedge funds. We'll see how things shape up heading into September, but we think in general things are pretty good. The question from Lawrence on financials. In financials, what percentages would be insurance as compared to banks? That's a great question. So if you think about it, we've talked about the insurance names that we're focused on. We focused on property and casualty through Progressive, PGR in the US, Fairfax Financial in Canada. We own some Intact, which is also property and casualty. We own Manulife as a life insurer. All of them are effectively a play on their ability to manage money, large investment portfolios. On the banks, we own a combination of US and Canadian banks. We own Goldman Sachs, we own JP Morgan, we own Bank of America. And then in Canada, we own CIBC and RBC. In general, the goal here is to own the best of the best. And we do think we are probably only a couple of years into what will likely be a long period of outperformance for financial institutions. In a world of falling interest rates, the power belongs in the hands of the borrower. Money gets cheaper and cheaper. In a world where we've entered a more inflationary world, where we're probably going to move higher in yields and interest rates in fits and starts over the next number of years, the power belongs in the hands of the lender. And these are companies that had a hard time generating a net interest margin through that period where rates went to zero. The picture is changing, and we think that there's great opportunity there. So, relatively quiet week. Good to see the market react favorably following Powell's meeting in Jackson Hole. It'll be interesting to see how the market reacts to NVIDIA's numbers tomorrow. Certainly it's a great company. It just may be very well owned. So we'll see and assess and have an opportunity to talk about it again next week. In the meantime, don't hesitate to follow us on Twitter. If you've got questions about your portfolio and you want to have a more detailed conversation, it's a great time of year because we're around and things are a little bit quieter. If you have questions in general about markets and strategy, we're available. So don't hesitate to reach out either by email or by phone. And I hope everybody has a great last week or two of summer. Have a great day.